There we go. There's a disclosure which I'm supposed to be showing, which I forget sometimes. Taskbar, backward long. And just a few minutes we can get started. I'll just muddle while I play with my screens for now. Silver down but bounced off 1468. Gold bounced off like 1108. But, we don't care about 1108. What matters is this 1110 line. It's just a spike. I mean, it doesn't count. What counts is that it held the 1110 line. It's right there. And that held up nicely. So that's really what the line's going to be. You don't pay attention like that. That's what we call spikes, because it's just a bit below and comes back so fast it doesn't really register. Like here, this line held, and this is also good. We just had a conversation about that in chat about whether or not to stop. Somebody asked whether or not to stop out. We set a stop on CCJ, and it went a little bit below the spike, and I was like, no, you don't stop out just because it just ticks below. It's got to have a real move down or close below it. If you set a stop and you're going to get out any time it ticks below, you're going to be stopping out a lot. So here, the Dow strongly held down here, which was 17.3. S&P pretty much 2075. 4,500, of course, is going to be bouncy on the NASDAQ. That's kind of a given. A 500 line on an index like that, and 1,200, of course, is just as bouncy on the Russell, especially when it was the support line yesterday. There were two good reasons for it to bounce. So it's going to take a lot for it to come back down now. But as we noted this morning, the run-up was a little bit silly, so we'll see what happens at the end of the day. Nikkei is holding on to 20,500, another 500 line. And DAX failed 11,000. Now DAX is in a bad way at the moment. That's Germany's ETF, or Germany's index, sorry. And meanwhile, oil is the star of the day, almost coming back to 43. Very exciting move. All right, how are we doing? A few more minutes. Let's get back to our disclosure screen. Let's see if anybody has a quick question, just in case. And nope, nobody has questions. Fantastic. That means I should think of everything to say all by myself. All right, one more minute, we'll get started for sure. John says, any question, even non-finance? Well, at the moment, if nobody else has a question, who cares? Let's see, my favorite One Directioner is Harry. I'm on team, I don't even know what it is. I'm trying to confuse the things my kids care about. I'm on team Werewolf, whatever that guy's name is. Oh, that vampire guy is creepy looking. And I'm loving Donald Trump. God, that guy's hilarious. I also love him because I'm a Democrat and he's totally destroying the Republican Party, so that's fun too. It's a good trainer to keep an eye on. All right. Nothing good happening here as far as bullish stuff goes. That's a strong dollar, though. I mean, really, you got the dollar up to 0.23. The indexes are down about the same. Well, these guys are. The Russell is taking a big hit. All right, so back to our disclosure. Where'd that go? There it is. Okay. Got to put on my professional meeting voice. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed, tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, TSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read the characteristics and risks of standardized options. TSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options. We are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on the mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and will not distribute or sell your information to anyone. All right, that was exciting. All right, how's it going, everybody? Let's see. It's a Tuesday. We like Tuesdays. Tuesdays are much better than Mondays. Monday was a silly, silly day. Dead people liking Donald Trump. Yeah, I'm sorry. I like him because I'm a Democrat. That's why he amuses me, and he's terrible for the Republican Party. Let's see. Okay, don't say hi. That's not a good use of chat, but hi. All right. First of all, let's take a quick look at the market. Got so many things we can talk about today. So the indexes are weakening at the moment, but we're testing these lines. See that support? And I said this morning, I forgot what lines we talked about this morning, but we already did discuss these. All right. Unfortunately, we talk a lot during the day. So here we go. So we were looking for 12, 16, 50, 2092, 17, 450, and we're below 4545. We're below 1250. We're below 2095. And here the only one left to cross is the Dow below 17,450. So he's what you call a laggard at the moment. So if you're going to short, you want to short the Dow. We can. Let's go ahead and do that for educational purposes. We're going to short the Dow because we think it's going to slip below 17,450. There's one. I'll do another one since it's 460. Oh, and I'll do another one, I guess, if we can fill that. 3. Okay. So now with 3, they're $5 per pay. They're $5 per point per contract. So when I have 3 contracts, I'm actually betting $15 per point. And of course, it immediately moves against me, which is kind of annoying, but also fine. So we're going to see how far up it goes. 66. Let's see if we can get another one at 66. That'd be nice. Oh, 67. See, now you don't jump on it because this happens. It's moving up, so I'm not going to fight it. I'm just watching these fills. Look at that, moving up again, really getting against me. The second I did it, see, that's interesting. All right, so here we seem to be equalizing a little bit. I still have no reason to think the market should be going up, I mean, unless I missed an announcement or something. So let's see. Blew my chance. Oh, don't go down any further, and I'll be upset. All right, I give up. I'm going to take one at 66. All right. So now my average is 462. Now remember, we started at 460, and I just kept following it up, and I added a few. So right now I'm betting $20 per contract because I have 4 contracts. They bet go $5 per point. So I'm betting $20 per point on 4 contracts. And I'm looking forward to move back to test the 17,450 line, where hopefully I'm going to make, and I know exactly how much I'm going to make. I'm going to make 12 times 20, which is $240. So that is my plan. I'm actually even going to put a sell in here. Not a sell, a buy, because I'm short, so I'm buying. So I'm going to have one here, so it's going to go off. Even if I'm not watching it, at least I'm going to hear it go. All right, so that's going to give me an idea if that thing feels going to get distracted by other stuff we're going to talk about today. Probably we should keep an eye on the dollar or something. Let's take a look over here. DX, see what else is moving. No real movement in the dollar, so I mean, I'm not quite sure what this market movement's about. We can check the news, and a quick check of the news tells me nothing. We still have very weak volume. Nothing since I last looked. I just posted news in member chat, and there's really nothing new there either. So we'll see what happens. But I have faith in this. I'm pretty positive the Dow's going to go at least to here, possibly to here. That'd be a nice chunk of change, though, if we get all the way down there. But I'll be happy with making 250 down here. So that's basically the game plan, and we'll see how it works out. All right, now, let's talk about some stuff. I wanted to talk about filling a position. That's very important. Oil already popped. We had a couple of positions in, not you. Okay. Here we go. This is, in Seeking Alpha, I'm doing this thing called a 5% monthly portfolio. We're trying to make 5% a month by taking various positions that should hopefully make $1,000 each. And we've done a few so far. And I'm just going to pick, well, actually, I can just go to the portfolio, can't I? That's silly me. I've already got a summary of all the positions that are in the portfolio. So here's the 5% portfolio, which is new. It's currently up a little less than 1%. That's actually a pullback from last week. But it's kind of hard to go intraday and figure out to do what's going on. So what we have, though, is we have two bull call spreads. We have one on gold, GLD, and we bet that gold, this came up about, well, they all came up last week. It's a brand new portfolio. It started last week. We decided that gold had bottomed out, what day was this? On the 8th. And if we take a look at gold on the 8th, GLD, we'll pull up this chart and we'll go back 5 days. Was it 5 days ago? Ooh, that's so ugly. How do you make that go away? Oh. Are you kidding me? What are these things? Why would you show that? No. Line area bar candle. What is it, a study? Whatever it is, I hate it. Indicator. Is it an indicator? Money flow, relative strength. I don't know why it's doing that. It's ugly and I don't like it. Anyway, all right, well, wait, what's this? That's what it is. Show pre- and post-market data. Wait, so when you show it, what's it showing you? There's no data. It's just like pictures of like the sun and the moon. That's data? All right, anyway. Awful. Okay, much easier to look at this now. All right, so here's gold, and here's, that's the 12th. So I guess I got to go back a month. So on the 8th, here's the 8th. Oh, it was Saturday we were looking at. That's right. So I wrote this article on Saturday to kick off last week. And I guess it was Saturday morning last week. And we decided that gold was going to hold the line and go up over the 106 line and hold that into expirations, which are Friday. So my first post for Seeking Alpha on this new portfolio was introducing the 5% monthly portfolio. And our trade idea was FXI. Here you go, gold. All right. So we had it. We talked about a previous gold trade and which one worked out, one didn't. And here was gold on that day. Oh, that's nice. It's frozen. That's cool. So here was gold on that day, and it was 104.65. And we decided that we would pick up 20 of the 104 calls and sell 20 of the 106 calls. That was our game plan for doing that. And there's a $1 on the $2 spread. So here we are today in that portfolio, and the spread is currently showing at about 130 something, 133. Okay, so there's a little bit of a gain. So actually, you can see it's 2,400 minus 700. You got almost a $700 gain on that spread. So that's not one I would take right now. But however, the USO trade, which is April, has this one you can still take, because this was originally a $1.10 spread. Now it's $1. It's actually losing money. So here's a good example for a setup. And the point was I want to show how you enter one of these trades. So we're going to use this one as an example because we can still fill this and it's got plenty of time to go. So we're going to set up this bull call spread in our portfolio, and I'm going to show you how to do that. It's going to be you go to the thing that you're betting, and that's USO, and it was the April 12/50 14/50 spread. So you go to the month that you want, April, and you look at the 12/50 calls. Now currently, the spread on the 12/50 calls is 245, and the ask is 254. On the 14/50s, you have 133 and 146. So basically, it looks like in the last sale here was 145, and the last sale here was 250. So it looks like about $1.05 and $1.10 ought to fill that spread. Originally, we looked at this spread at 108. All right, so it's still exactly where it was. Now the funny thing about this stuff is, though, you're always going to get the worst. In other words, if the bid and the ask are, if you have to buy something to close it, so these are short, I have to buy them to close, it's going to show me the ask for this position. If I want to sell it, it's going to show me the bid, the amount that's offered. So it's going to show me the worst of each price. So you always have to remember that about your portfolios, that things are often better than they seem with the options because it's showing you the worst possible case. And the worst thing you can do is take this thing's word for it. Now, oil, meanwhile, fluctuates all over the place. Well, there's a chart I don't have. Hang on a second, let me find one. I'll show you my favorite charts come out of FinViz, but I never know how to access them other than just to copy the one I already have. Here we go. So I just open that in a new tab, and then I have the thing. All right. So USO. So you get a lot of day-to-day up and down volatility, a lot of week-to-week volatility all over time. Right now, we think we're bottoming here at $14 on USO. All right, so if I want to fill this spread, which was now remember the spread is a 12/50, 14/50 spread. It's not very ambitious. But what I want to do is I want to offer a low amount here. So I'm going to say I'm going to buy. Now, you can, I'm sorry, let's do one thing. First of all, you could buy the vertical. Let's even show how that works. Here's the vertical, and I'm doing 12/50. See how it says vertical buy? I'm just going to buy 5. So I'm just showing you how it works. There's 5. All right, so I want to buy 5 at 12/50s, and I want to sell the 14/50s. That's what the spread says. It's very simple. Well, in other words, where's the original? Here's the original. That one, probably. Nope, this one. All right. Here's what it says. Buy gold, 104 calls, sell gold, 106. What's important if you're going to set up the spread in your portfolio is to know the net. The net's $1. And I wrote that in there also. So the net's $1. And you can say, I want to pay how much? I want to pay $1. Right there, you can say, I want to buy the 12/50 calls. I want to sell the 14/50 calls, and I will pay $1 for that privilege, okay? And I'm going to put this in instead of day. Order limits. Limits very important. Never, ever, ever do a market order. Yeah, and the other stuff is way too complicated. I'm not going to talk about that. Now, the term of the trade, it's a day trade, or it's GTC means good to cancel. That means it's going to stay over after today. I have till April to fill this thing. Anytime the spread is $1, this thing will fill it for me. Okay? I think, though, at these prices, even though it doesn't look like we're going to get a fill. So let's see what happens. So we're going to confirm and send. And it's telling me I'm going to spend it's telling me that I'm going to spend $500. I can make up to $500. My max profit is $500. The cost of the trade is $500 plus commission, blah, blah, blah. And your buying power effect on it takes out that much of my buying power. So it tells me what's going on. Go ahead and send it. and it does not fill right away. Now, in lieu of that, another way to fill a trade like this, which I prefer, which is why I only want to do 5, I want to buy the 1250s and for 245. Whoops, wrong one. So I'm going to buy them for 245, and I'm just going to place that order. Boom. That didn't fill either. Okay. Now I'm going to sell the 1450s, and today I want to sell them single. Same thing. I'm just going to sell the 1450s. Whoa, that was weird, and that caused Thinkorswim to crash. Okay, that was annoying. Hang on, is my meeting thing still working? Did I lose you guys? Can you still see the screen? Yes, no, maybe? See, okay, great. All right, hang on, let me get that thing back. Oh. Hang on. I'm going to have to stop sharing for just a minute, but let me get this thing right. Thinkorswim. Did anybody else get Thinkorswim crash on? That was weird. It never happened in one of our demos before. This thing will start back up. While I'm doing that, I can look up some questions, see if anybody had anything to say. Now, logic regarding SPY options. Did I actually say that? Oh, it's a big thing to chew off. What happened? Yes, I am recording. What happened to the iRobot position in the $5,000 portfolio? Oh, that's interesting. Did I forget to enter? I probably forgot to include it. Or didn't it fill? I don't remember. I'll have to find out. What's your opinion of working volatility skews? May you seem think plain skew, be all. I like those. We do those into earnings sometimes. All right. So where are we with this thing? Well, now I've lost track, so I got to see what happened with my order. All products, USO. We're in the middle of looking at it. Oh no, here you go. Here's my order. Wait a minute. Position. To go. But anyway, so the point being that you just enter the two separate orders, and then all we have to do is wait and see which one fills first. And then once one side or the other fills, so I put in a high offer here to sell at 145. I put in a low offer here to buy at 245, and one or the other will fill first. Hopefully the buy will fill first because I think we're at a low. And if the buy fills first, I've got a very good chance of getting my price on and move back up on the other side. But you don't have to buy them all at once, and you don't have to buy the legs together. You can break these positions up and take advantage of the market. So in other words, USO has been creeping up today. Oh, and you can see my orders right on the thing. That's nice. All right, so USO has been sort of up and down today. We're going to need a down move to fill our buy, and we'll need an up move to fill the sell. All right, and so far I have the extra order. So the extra order is here on the buying. And what's that? You should tell me what it is. Buy 5 vertical. This one says buy 10 of the 1250 calls. What I did not do is I did not fill the second part then. So I have to look at that. I have to look at selling. That's when it crashed. So I still have to sell, and I'm going to sell 10, and I'm going to ask for 150. Screw them. Okay, so I'm going to sell for 150. That's higher than it says here. Because if it fills, it fills. If it doesn't fill, it doesn't fill. We'll see what happens. But always try to get better than what they're offering. Don't try to get the same as what they're offering, because if you compromise yourself by just a dollar trade, or a dollar contract especially, 10% of your trade, you can't afford that. Nobody can afford that. So my attitude about filling these spreads, of any kind of spreads, or getting any kind of option, is I'm either going to get it for a good price or I don't want it. Even though I already think it's a bargain, even though I already like the trade, I still want a better price than that. Because if I'm a cheapskate and I only do it when I get a really good price, then if I save myself 10% every time I make an entry and every time I make an exit, I save myself 10% because I hold out for my price, then I'm going to do 10% better, 20% better than if I just flow. So of course I want to do that. Of course I want to work into the trades. And you have to use your head too. This is 241 days from now. Do you think oil's not going to go up and down in 241 days and fill this order? Very, very unlikely that it won't. And if it does, and if only one side fills and I get stuck and I'm not paying attention and it goes shooting up on me, then I have to figure out how to make it into a different kind of trade. But it's no big deal. And it's no big deal when you understand, when you understand what you're trading. It's not a big deal. It's the problem is if you don't bother learning this stuff, if you treat it like it's not important. Think about, it's not just about making trades. You have to think about why you're trading, how you're trading, so on and so forth. Okay. So that was something very important I want to talk about, is making fills. Now, what else do we have? All right. Now, Rich says, I said, which I don't remember saying, but I'll take the word for it, that we would walk through the logic yesterday's chat regarding out-of-the-money SPY options. I did not say that, Rich. I went through the logic in our chat room. You can't fool me into having a lecture about something I didn't say or did. I know what he's talking about, though. We were talking about SPY. Should we get back to lumber liquidators? Yeah, let's try to follow through all this. We'll get back to lumber liquidators. SPY. Okay. And I'm trying to find the part which I promised to do something. I didn't think so. Where here does it say I'm going to talk about this? As a bet, it's fine. Favorite hedges, if you're willing to do it, even can be rolled. I did not say that. Okay, I feel better. Webinar. And double check just to see what I did say. I didn't say anything in the webinar. It's interesting. I would have thought I did. All right, SPY. Just one, I said something about saying something in the webinar. So the original question in chat, this is how, in case you guys are not, and for those of you who aren't members, this is what our premium member chat room looks like. After the post, we have a comment section, obviously, and it's for members only. So at the bottom of every day's post, there's this comment section, and we just have our chat all day long, back and forth, talking about all the relevant issues and what's going on in the market and so on and so forth. And the members get to ask questions. So JMD asked a question. He actually, Farm Boy is one of our models. He liked the 198 SPY puts. and the 113 for IWM. So he likes the October 198 SPY puts. JMD said, I like the SPY puts. Would you think this is, what do you think this week to do this weekend for good hedging is the FPS, the target, blah, blah, blah. So I don't like it just because, I mean, look, I very much respect what Farm Boy does and all that, but he's in this particular case, this is not a trade I like. He knows what he's doing. He's reading, in fact, he says right here, going to let things shake out. The delta is about right for a collapse in a few weeks. Quarter entries up to about 50. So he's saying he's got a strategy here. He's into this in 1 quarter entries, maxing out at 50. He's expecting he may have to put a few more in at a lower price and hopefully work into it and then catch a nice fall, which is not a bad strategy, but it requires a lot of attention. What he wants to do requires really staying on top of the trade, taking advantage, scaling in between buying a little, buying in parts and scaling out. Now, he knows how to do all that stuff. I'm not a big fan for an average trader, though. It's a tricky play and a tricky way to work it. So what we talked about here is when he asked me, I said I'm not a huge fan of out-of-the-money puts as the premium decay bites you. SPY is at 210. The October 98 puts to 110.92. So let me in fact, yeah, I'll show you. Here's the idea, though. I will show you why. SPY is at 210.25. Okay. These are October 198 puts. So why don't I like these? SPY. Because first of all, SPY is at 210. So if you buy the October, September, October, if you buy the October 198 puts, they are here. They're $1.70, okay? I think that's about what they were yesterday. Doesn't matter, though. They're $12 out of the money. And you've got 60 days, 59 days to hit it, all right? So what does that tell you? Well, that tells you that you take how much you spend, $1.60, divided by 59 days, and that's 2.7 cents per day. So you will lose 2.7 cents per day. The second you buy these, and they're not that expensive, they're only $1.70. So you're going to lose almost 2% per day by these things if the S&P doesn't go down. So unless the S&P goes down faster, and how far down does the S&P go? It has to go, well, for you to get your money back, it has to go $1.70 below 198. So it has to go to 196.30. So then I would say 210 minus 196.30 is 13.70 divided by the same 59 days, 23. So the SPY has to drop 0.23 per day, every day, including Saturdays and Sundays. We're not, we're not being fancy here. Or every week, 7 times that is $1.40, something like that. So the S&P has to drop almost 1% per week for the next, whatever 60 days is, 9. For the next 9 weeks, the S&P has to drop every single week, has to drop 1% just for you to get your money back. All right? Anything else is going to be a loser. Now, it can drop quickly, and if it drops soon, you can get some of your money. You'll get a quick gain. But if you intend to hold this for that duration, you're going to have to get your money back. It's going to be a long, hard road for the S&P to drop. And then, so now you say, well, also you have to think about that. And then you look at the S&P. Where are we? That one. So we're going to look at the S&P. And you got to say to yourself, is it realistic that the S&P is going to come out at, I'm sorry, we'll use SPY because it's easier instead of talking apples and oranges. So we'll look at SPY. And what was the number I said, 196 or something like that? So if you look at the S&P and you say, okay, 196, it's got to get from here, where it is now, not to 202, not to 208, 196. That's way down here on this chart. So it hasn't been there since March, hasn't even hinted that it's going to go there. You have this big, fat 200-day moving average that's heading up. That's going to be really, really hard to punch through. In fact, so hard to punch through the last time it tried, it went flying up 10 points. And you've only got 60 days. Look what this test chewed up. This test, when it came down to the red line, it took 1, 2, 3, 4, 5, 6, 7, 8 days to consolidate down here. Then it went up and wasted 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So about 20 days here just to test it the first time. Then it's been wiggling around for another 20 days. So figure here, if you're lucky, in 5 days, 6 days, 8 days, it's going to test this line again. It's not likely to go through. It'll probably, what it'll do is it'll stay down here if it goes down, and until this blue line does a death cross, goes under, you're probably not going to get enough force to push you below the 200-day moving average. So you're going to be chewing up your clock, basically. It's like running out of playing football, right? You're going to chew up the clock on those options while you're waiting. And then, even if it breaks down, though, you still need the son of a bitch thing to go down 10 points. That's a big move. I mean, yeah, 10 points. It's 10 points out of 200. That's 5%. You need a 5% drop to get in the money. And how much money are you going to lose? We talked about that. You're going to lose 2.7 cents per day. So at this exact moment, I don't like to trade because I think it's going to be at least 10 to 20 days before it even has a chance of breaking below that 200-day moving average. And if it's going to be 10 to 20 days before it breaks below the 200-day moving average, then you're throwing away 25 cents, 50 cents out of $1.40. That's a lot of money. That's 20 to 40% you're going to lose before you even have a chance of this trade coming around. That's why I said yesterday I don't like it, and that translated into me saying I'm not a huge fan. So I looked at all this stuff and then I write something, right? So there's all the background stuff to what I do when I'm talking about it to people in chat. So people ask the question. He asked this question at 1:37 and sometime around 3 o'clock. Obviously before that time, and sometime around 3 o'clock, I started writing this answer. I'm sorry. 3 o'clock when I print the answer. Of course, I wrote all this stuff. And then I hit print. So, whatever time it was. But at some point after he asked the question, I looked up all these things. I did everything I just did, and then I sort of condensed. I know it's confusing because of what I obviously looked at all these things. But I said the October 98 puts at 162. They've got a 19 delta. You'll lose 25 per day. I do this in my head, so I wasn't, calculating it out. For the 60 days to expiration, you need SPY to hit 196.38 to get even, which means 23 cents a day you lose. So it's exactly, but it's funny, oddly enough, exactly what I just calculated for you when we just did it is exactly what I said yesterday also when I was doing it in my head. The S&P doesn't go down, and if the S&P doesn't go down 0.1% a day, go down 0.1% in the last 90 days, you will have lost, in the last I'm sorry, I was looking back, I did the chart, I said, look, in the last 90 days you would have lost, in the last 6 months you would have lost, in the last 9 months you would have lost. The only time you would have won is if you go all the way back, and I have to go on this chart now, let's go all the way back to last year. That's the only time we went below that 196 line where it would have made some money. One time in the past year, not this whole year, because you have to realize what kind of bet you're making. This whole year, maybe here you could claim that you would have hit it if you did it just right. But this whole year, one time, this whole year, maybe one time. So about once a year, you have a chance of getting a dip like that in the S&P. Not that history can't change, but you have to look back at recent history and say, well, okay, so it's a 1 out of 4 chance. If you're playing for 60 days and it happens once per year, it's a 1 out of 6 chance that it's going to hit, right? It happens once a year. You've got 2 months that you're playing. There are 2 months out of 12 chances to hit it. Now, when you're only going to get paid 1 out of 6 times, that's a 15% chance of winning. That means if you're not getting paid 6 to 1, and 6 to 1 is only 90%, if you're not getting paid 6 to 1 when you win, then why are you spinning the wheel when it has 6 numbers on it? See, this is all about risk-reward. This is something else you need to do when you're looking at your positions. You need to say, how much can I win? How much can I lose? That's my risk-reward ratio versus how sure am I this is going to happen? So even if you were 100% 6 times your money, if you were right, you still have to get the timing right. Because if you take 6 chances, you're going to lose 5 times at least. So even if you are completely right and the S&P will break down, if you don't time it right, you're still going to lose. You got to think of those things. You got to think about that when you're planning these positions. And again, Farm Boy is going to take advantage of this. See, he's not playing this. He's not playing it for the big drop down there. He's not playing it as a hedge, and that's what today. The options in, but that's not the way he's playing a hedge. And then we talked about playing a hedge instead, and I talked about the way I like to play it is I would rather take a bull call spread where I'm not playing premium. And in top trades, oh, you know what? I really do have to. No, that's top trade. Yeah, I do have to update these portfolios before we start referring back to them as far as that money goes, because I didn't put all these in. We had a top trade on TEX, and in that trade we sold the $23 puts for 2017 for $3. And yesterday they were still $265. And I said, look, this is what you want to do. It's like you want to sell some puts in a stock you do want to buy if the market goes lower. You say, hey, there's a stock I wish I owned at $23. TEX popped, and it's probably going to break over this wire over time, but right now it's consolidating out around here. It's fine. I like this 23 line to hold. This is currently the 50-day moving average over here, and I like that line to hold over time, and that's $23, and I expect that over time it'll keep going up this way more or less. So everything's going to curve this way on TEX. So for various reasons, we like it. So the bottom line is, though, if you take the money, you get paid $265 for selling the puts. If you sell 10 of them, you're promising to buy 1,000 shares of TEX for $23. But if you really want to own it, where's the harm to you? I really would like to own TEX for $23. It's currently $25. Someone's going to pay me $2.65 to promise to buy it, or it's $2,650. You get paid for this. Then you set up a spread, and in this case I like the SDS spread. And I like the SDS spread because SDS is a 20, and we can take the $18 calls and sell the $21 calls. That spread nets out $27.60. All right, so it's only $110 out of pocket, and you can have the $6,000 spread. You can have 20 of these contracts that goes from the 18-21 spread. And the only way, see, when it's a hedge, the only way you can lose money on the hedge is if SDS goes lower. And if SDS goes lower, it means the S&P is going higher, which means your long positions are making money. That's what makes it a good hedge. So I'm protecting a $6,000 drop in the S&P or in my portfolio of the S&P. So let's say you have a $100,000 portfolio. If you're playing your $100,000 portfolio right, as long as the S&P doesn't fall, you should make $5,000 over time between now and January. You know, you should make 5%. If you're not making 5%, you're doing something wrong. We got a portfolio that's going from 5% a month, so we're talking about making 5% between now and January. So your bullish positions on $100,000 should make about $5,000 at least. This play is only risking $110 of cash. You can't lose more than $110 in cash. You can end up owning TEX But in any ordinary conditions, it's not likely the S&P is going to go up and TEX is going to go down. So as long as the S&P goes up, you're going to make a lot more money than you'll lose on this trade, and you probably won't end up owning TEX. But it was good insurance. Now, if the S&P goes down, okay, you may lose. Let's say the S&P drops 5%. Your $100,000 in positions might lose 5%. But if you sold puts and calls and so on and so forth against your positions, you should be okay. But meanwhile, you'll get paid on this spread. You'll get paid $6,000. That'll offset your costs. Now, you don't want to mitigate all of your damages when you're taking a hedge. You want to mitigate about half. So maybe you have a $200,000 portfolio and you're looking at hedge and you think it'll drop 10% and you're going to lose $20,000 and this offsets $6,000 of it. That's still a good hedge. If it goes up, if you were, assuming you're bullish, generally it's just an insurance hedge. It puts an extra $6,000 in your pocket if the S&P goes down. It also puts TEX stock in your pocket, but the $23,000 you spend there, less the $6,000 you make on your bullish spread, is $17,000. Now the question is really, are you willing to buy TEX for $17? Well, it's at 25. If you're not willing to buy it at 20, if you're not willing to buy it at 17, why are you even thinking about the trade? And again, TEX is just an example. The idea is any stock you want to buy, you should be doing this. In fact, you shouldn't even buy a stock unless you're doing this kind of stuff. You think about all the stocks in your portfolio, you should only be buying stocks by selling puts. Because that way you can use the put money that you sell as a hedge to protect your other stocks, and then meanwhile, if the index goes down and your stock gets cheaper, you get it for a cheap price, and you have some cash to buy it with. It's a win-win. All right, and that's how we set up our long-term portfolio. We have our long-term and short-term portfolios at Phil Stockworld. That's what we do with them. All right, now, back to lumber liquidators, which we talked about. It's a very important conversation also. LL. See, we have more than one thing has LL in it. Holy cow, really? Let's try this. LL. See, sometimes I can't find things. It's too... Okay. Now we get to that next. First, let's see if we have any questions on that incredibly interesting topic. Hang on. Here we go. All right. Oh, no extra questions on that. Great. All right. What happened to the iRobot position? Yes, I failed to enter it. Maybe it never filled. I have to check the numbers and see if it did fill. Oh, and by the way, the way I check the numbers to see if a fill was made is very simple. You go iRobot, IRBT. Oh. No, I forgot about we shorted it down, didn't we? So we go to iRobot, and we go to I don't know what we were trying to buy. Hang on a second, I'll find out. Okay, iRobot, right. Yeah, I'm behind on this update. All right, December 27 calls for 5, December 32 calls for 220. All right, so what we have to do is go to this iRobot, and you can all do this in Thinkorswim if you want to, and we say December, and they were the 27 calls, right, for 5. So the question, oh, it's right here. See the last transaction, $5, so they did fill. And you see here where it says more info on iRobot, and then you go to what they call the quick chart. It shows you every fill. All these little lines are the fills on iRobot. So here's 491 on Friday. Here's 473, 480. So in other words, 5. Here's a bunch of 5s. 5, 5, 5, 5, 5, 5, 5. So easy fills on that part. And what else do we have? Let's see. Sell December 32 calls for 220. So now we go to December 32s, And obviously they sold for 220 because that's 257. So they've been selling no problem for that price. Same thing though, I can look at the chart and I can see on Thursday 270 and actually 220 was too low. Nobody paid 220. You know, there's plenty of better opportunities to sell. All right, so I just give the best price I just give a price that I think is reasonable to get when I put down the trade. And like I said though, my attitude about it is always I always ask for better prices than that. But that's the price that I consider fair at the time I do it. Usually I'll look at the last sale price and I'll look at the bid and the ask and I'll see if it's still reasonable. So in other words, right here you see 270 and 230 is 40 cents apart. So obviously in the middle is 250. And I'll say, is 250 still a reasonable price for this option? And I go over here and I say, oh yeah, 250 is a reasonable price for that option. But the last sale was 257. So I'll probably write 255 or something like that as my answer. But I'm always going to put down what I think is reasonable based on the bid-ask spread. Here's $5 for this, and you've got 470 and 550. Might be a little hard to fill, but I'd still go for $5 on these. Whoa, what happened? All right. So the IROBUT spread did fill. I just have to enter it. What is your opinion of volatility skews? Now, volatility skews, he means playing one option against the other, like a long and a short for different time periods and so on and so forth. A lot of times we do this with earnings plays when the front month volatility is high, and we'll sell that, and then we'll try to buy something further down and take advantage of the earnings, which has a volatility crush. Once the earnings are announced, the stock is no longer as volatile as it was going to be going into earnings. We do them when we feel that the odds are really in our favor, but they're quick trades, and we would never do them outside of like in our member chat room where we can constantly adjust, because you can get really badly burned on those too. So yeah, I do like them. They're fun, and you can actually sit there and do nothing but that for a living. It's actually one of the better ways to do it, because again, it goes back to our core philosophy of saying you're beating the house. Okay, you're selling more premium than you're buying. Okay, it's just that sometimes though you can get, especially now, we haven't done it in the last couple of earnings because all these stupid stocks pop 10 and 20% on earnings, or go down 10 and 20. So when things are moving 10% on earnings, that's not the best way to play. All right, but it is a valid way to play, and something we do in member chat on a regular basis when the conditions merit it. Lately, though, the market's been too kooky for it. All right, let's see. Can you repeat what the trade is? I don't know what trade you're talking about. You mean the SPY trade? It wasn't a trade. It was a trade I didn't like. And the other one was a hedge, which wasn't really important. It was just an example. Dow contracts still open? Yes, they are. How are your futures doing? Well, great. I'm not too worried. Let's take a look, though, and find out how we're doing. Probably not good. Oops, wrong thing. Here we go. So we have 4 contracts. They're still hovering around the same spot. We have a little bit of a bounce here. So should I be worried? That's the question. Look, oil came up. That's tempting. That was a really tempting short there, oil at 43. It's a new contract that just rolled over, and now we're into that holiday period, which is what our bet was based on when we did it in the 5% portfolio. Remember, the whole point of that bet was we expected oil to pop up into the holiday. That was exactly why we made that play. So let's take a look at more charts. Weakish. This is the best one. Here's the S&P. See, it's really struggling to hold this line. I like that. That's the line I predicted, by the way, this morning. 209, 250. It's exactly where it is. 45.45 broke on the NASDAQ. So the Russell's a teeny bit bouncy, but it's, of course, the lowest index anyway, so I'm not too worried about the Russell bouncing. What's the dollar doing? The dollar's looking stronger, also putting pressure on the Dow. So right now, I have no reason to change that trade. All right, so just kind of watching to see what happens to it, but I'm so not worried, I keep forgetting about it. So, look at it that way. All right, where were we? Lumber liquidators. Okay, great. Now we can get back to that. No, there it is. So we screwed up. We have a big position on lumber liquidators in our long-term portfolio. Which is only up 35% now. Was up 40%. It's only up 35% because it's getting hammered with a lot of stuff. But we're not. Well, actually, the biggest reason it's down is because of stupid Netflix. That cost us $30,000 so far. We sold the 105 calls, and they're at 124. But we sold them for $20, so I'm not too worried. 1845. We just expect this to be the top, and then it'll go lower. On paper, though, because of the premium, we've got a pretty big loss. All right, but it's just a matter of time. Again, we sold premium, and short term, we're showing a loss. But in reality, if Netflix closed today at 124, that's up $19 from where we had it. We sold these for $18.45. We'd be down 50 cents. This thing's showing us down. I don't know what. We're down like $8 on this thing. But it's all premium. Premium expires over time. So it's just really a question of will Netflix stay under 125? Then we're going to be okay. I think it's going to go much lower. So Netflix is killing us. I'm sure there's something else that's killing us. Apple, we got these, we have these apples. We haven't adjusted it yet. But Apple 120 calls, now they're below 120. It's 2017. We're not worried about it, but it cost us $14,000. Because we didn't time it. Well, we didn't time it. We did time it fine because it's only a small position. It's only 20. We're going to eventually have at least 50 of these guys. But we're waiting for an opportunity to roll this lower and pick up more position. What? Okay. Let's see. Where the heck is it? Lumber liquidators. There it is. Okay. This is a roll, so it doesn't really show all the loss we have. But what we ended up with in lumber liquidators is we've got 20 of the $15 calls for 2017. Then they're at 15 now, so that's not particularly a great idea. We've got, overpaid. We paid $940. They're at $480. We have 10 of the short 25 puts, which are way up in the money, and we've got 10 of the short 25 calls. All right? So this position, it's an aggressive position on lumber liquidators. It's what we ended up with after rolling something. And honestly, we really should consider actually buying more calls at this point, not less. So yesterday we got into a thing because somebody said, or two people said, wow, what happened here? Oh, I see. Okay. Adel said they were talking about lumber liquidators. Okay. Well, we talked about they got that same 60 minutes piece that sent the stock crashing a while ago. Oh, here we started talking about it here. They ran the same 60 minutes piece again, and IHS was talking about throwing in the towel on the position because they went down yesterday. And I basically said, well, I'll just summarize it. I basically said, look, that's ridiculous because it's going down for the same reason it went down already. There's no new news in this thing. They're just rerunning the same attack piece that 60 Minutes had in the first time, ignoring the fact that really nothing has really come of it. And this is very important, especially when there's stories like this. When you've got a story, sometimes the story is positive and it's stupid, sometimes the story is negative and it's stupid. In this case, the story on lumber liquidators is negative and it's stupid because lumber liquidators, just to summarize it in case you don't know, lumber liquidators buy floorboards from China. Not all of it, but some of it. A certain type of floorboard they buy maintained a level of formaldehyde that was too high. And so if you're doing it, and that releases a gas, and the gas can theoretically be harmful to like pets or children or something like that. There are regulations in this country on the level of formaldehyde that can be in wood. And theirs was, CBS, 60 Minutes, ran tests at the behest of hedge fund guys who were shorting lumber liquidators. CBS ran tests that showed that lumber liquidators exceeded the limits in California, which has the strictest standards. The rest of the country, no, they're fine. But in California, which has stricter standards, their floorboards had a little over the limit, it seemed, okay, based on their test. Lumber liquidators then had tests done and said, no, that's not true at all. And you have to look at the conditions. There's also, see, there's rules about the conditions. If you, if you imagine that there is formaldehyde in wood, there always is, okay? It just exists in wood. So there is formaldehyde in wood, and what happens is if you put the wood in a tube and you test it in the tube, then it's going to, all the gas is trapped in there, and you're going to get a higher reading than if you test it in a natural environment like on a house and put the meter next to the floor in a normally ventilated room. And those tests are meant to be conducted in normally ventilated rooms in normal conditions, in the conditions in which the wood would be used, not in laboratory conditions to see how much formaldehyde conceivably could be in the thing. Fine splitting hairs, it sounds like something you don't want. You would. But meanwhile, this works. Just like, in peanut butter, there can be, 118 insect parts, but they can't be 125. Okay, in a jar of peanut butter. That's the law. Okay, and some states might have 126, some states might have 140, some states may say 97. So if you want to, so if you crack open a jar of peanut butter and you test it and you find this particular jar of peanut butter has 186 insect parts, then you say, oh, that's bad. That's too many insect parts. That's essentially the kind of hair splitting we're doing the lumber liquidators. And I know some of you guys might be saying, ew, but you have to realize there's bad stuff in everything. So, my kids freak out about that. I showed them once, so I should have never showed them that. I showed them what the health laws were for certain things like that, and they were like, oh my God. They're like, they don't want to eat anything. Even worse if you know what's allowed and not allowed in a restaurant. Like, how many rat droppings are allowed in the kitchen? It's the planet. Okay, there's going to be bugs, there's going to be rats, there's going to be, it's like you can't have this sterile environment in kitchens and so on and so forth in restaurants. It's just not going to happen. There's going to be X amount of hairs in food. There's going to be this and that. That's all part of living in the world. So in this particular case, they realized that the hedge fund guys who were shorting lumber liquidators realized they would be vulnerable on this issue and created a mountain out of not even a molehill. I mean, they created a mountain out of nothing. And it's a big story, and then of course the same hedge fund guys, they spur on these class action lawsuits, and all the lawyers jump in looking to make money, and it's a whole big mess, and now the company has to deal with it. So I talked about how the same kind of thing happened in 2010 with BP oil spill. It was not that was catastrophic, and the company recovered. Okay, what lumber liquidators is not catastrophic. It amounts to not even 20, something like 10% of the wood 10% of the wood that they sold in California, which is maybe 20% of their total market in America. So 10% of 20% of the wood, which is now down 2% of all the wood they sold in a given year, may conceivably be above the limit. And then you'd want to individually test it. Lumber liquidators already took a loss because they sent out testing kits to every single person in the entire country. Didn't have to. They sent out to the entire country, everybody who bought the wood, and said to them, if your test comes back positive, we're happy to replace your wood. And actually what happened is they didn't really have to replace anyone's wood because the tests don't come back positive in that environment. But now 60 Minutes and the hedge fund guys are trying to say, well, but you gave them your test. We want to give them our test. Yeah. And now the lawyers are suing and trying to get lumber liquidators to pay for like these really expensive not EPA. I mean these tests to come in like $1,000 per home test to figure out whether or not they've got a problem. So it's idiotic. It's going to go back and forth for ages, just like the BP thing did for years. But that doesn't change the business. They're still going to sell floorboards. People are going to forget all about this, okay? It's like people still go to BP for gas. Don't you think people still go to Exxon for gas after Exxon Valdez destroyed half of Alaska. Okay, you still buy your gas at Exxon. And BP, nobody even thinks of not going to BP. There wasn't even a call to boycott. There was at least a call to boycott Exxon at some point. Nobody called to boycott BP. which is ridiculous because they should be boycotted. But lumber liquidators, it's just they got some bad floorboard from a supplier. It's not the biggest deal. So the stock is ridiculously low, but just because it's ridiculously low doesn't mean it can't go lower, and it doesn't mean it can't, and it doesn't mean it's going to find a floor. But eventually, this is a company capable of making money. They made money. They made $2.30 per share last year. That's a PE of like 5. All right, so about 6, or I call it 6. The PE of 6 from last year. This year, they had to recall some wood. They had to send wood back to China. They had to deal with lawyers and all that crap, so they're not making any money. Plus, they lost some business because they got scared away. Because some hedge fund guys called their buddies in the media and had a hack job done on the company. That made the company cheap. Nothing wrong with their business model, nothing wrong with their services, nothing wrong with the wood that they have in general. Just this. This is a passing storm. It's a reason to invest, not a reason to run away. It may take a long time to turn around. It could take a year, it could take 2 years. But meanwhile, where are you going to get a company like this? You know, until this for this price, this is what you call value investing. You have to look past the short-term issues. Lumber liquidators, since here, 2011, has been a nice, rising, fun business. Okay? This was overdone, but they're probably in this range. I mean, like I said, they make $2.50 a share, so you give them a PE of 50. I mean, you give them a PE of 20, and they're good for $50. But I'm not telling you to buy them for $50. I'm not telling you to buy them for $25. I'm saying if you buy them for $14, they're probably going to go to $25. Not now, not today, not tomorrow, but if you like making from 14 to 25, which is what, 50%? If you like making 50% in 2 years, it's a good trade. But not if you bail on it because it doesn't go your way. I mean, I guess that's the problem with value investing is people expect everything to be like now. What is it going to turn around now? Is it going to come back now? It's like, because as soon as you put your money in it, if it does anything other than go up, you get upset. Here's where the scandal first hit, went from 50 to 25, obviously have supported 25, but then went even lower in the second leg down. All right, I hate to say it's a buy because I've been banging the table on these guys since 25. I called it a good deal here. When it got down to 25, I'm like, let's buy it at 25. Now it's at 14. I'm only saying buy more. I'm not saying, oh my God, it went from 25 to 14. I don't care what the price is. And this goes back to, and we do this almost every month, we end up talking about it, this goes back to my Levi's example. Okay? If Levi's are $100, I'm not going to buy them. I think they're worth $50, right? So when Levi's goes up to $100, I don't want to buy them. When they go back down to 50, I don't want to buy them. When they go to 25, though, I'm going to buy a pair. I might even buy 2 pair because I know they're worth 50. Just because they're not priced at 50 doesn't mean they're not worth 50. Or not even 50. Like I said, the normal price is 50. So let's say they often go on sale for 40. So at 40, I get kind of interested. When it gets to 25, I buy it for sure. But when it goes to 14 after that, I don't go, ooh, I don't want my Levi's anymore. Get rid of them. I can't believe I bought these things for $25. What an idiot. Oh, quick, Louis, take away my jeans, please. I'll take a loss. Why wouldn't I do that? Because I still have use for them. They have value to me. I wear them as jeans. The fact that I lost $10 on them isn't really important. I got a pair for a good price, right? If you're a long-term investor and you get a stock for a good price that you're going to own for 20 or 30 years, what difference does it make if the price of the stock goes lower? You're going to get use out of it. All right, and another problem, here's the other problem you guys have, is that, and when I say you guys, I just mean people who get worried about this sort of thing. But the problem is you don't think of a stock as a living thing. You don't think of it as something that's going to stay with you. You don't think of it as an investment. Because first of all, because you don't think about getting an income out of that stock. When lumber liquidators stabilizes, wherever it does stabilize, you'll be able to sell options against it. Okay, so right now, for example, at 1470, if I own $14,000, if I own $14,000, 1,000 shares of lumber liquidators at 1469, okay, so let's say $15,000, I can sell the September $15 calls for $1.32. So if I sold 10 of them, here's how it goes. All you do is say sell, single, calls, and I want my $1.30, and I get $1,300. I'm basically paying myself a dividend. All they can do, when I sell a call, all they can do is take my stock away from me for $15. I'm selling someone else the right to buy lumber liquidators from me for $15 in 30 days. It's at $14.68 now. But because I'm willing to let somebody do that, they're going to pay me $1,300, $1.30 per share up front, 10% almost of the stock, for a month. For a month. That means if I do that every month for the year, I will collect 120% of lumber liquidators' price over the course of a year selling these things. So, now, I'm not saying I want to sell them now because they're too cheap right now. I want to wait till it gets close to like 2025. Then I'll be happy to sell because that's going to be my entry price on the stock. So I don't mind getting called away at my entry price or better. I do mind getting called away below my entry price. If I want to, what I would do is sell more stock to lower my entry price to average out to a price where I do want to sell calls. But when I can sell calls against the stock for 10% a month, I see an opportunity there. Just like if I bought a house for $100,000 and I could rent it for $1,000 a month. I say, well, wait a minute. I bought it for $100,000. I'm renting it for $1,000 a month. That means I get $12,000 a year back on my $100,000. That's 12%. If I'm only paying the bank 6% for a mortgage, that means I'm making 6%. Not only that, though, but I'm paying off the mortgage. So maybe by the time so in other words, let's say my mortgage plus interest comes out to right about $12,000. This is the logic to buying a home and renting it, right? I buy the home, I rent it. I'm paying a 6% mortgage. The $1,000 a month covers the $100,000 I borrow with the interest, and assuming I have limited maintenance and repairs, that's always a big if with housing. But what it does is, although I don't have a lot of cash flow from the property, I am paying down the mortgage, and eventually, 30 years from now, I'll have $100,000 free and clear. That's the logic to renting a house. Now, hopefully, and then plus if the house appreciates, I'll have even more money. That's what you're doing with these options. When you sell call contracts against a low price stock, against a low price stock that you own, you make that money. Hey, look at that. What filled? Oh, the USO calls. That means the USO must have gone up further. Pop, look at that. Now, that's not good because we sold the call short. We didn't buy calls yet, so we have to be careful about that. But now, I know what I have to do. So I go back to USO, and we're coming into 230, so it's probably a pop into the NYMEX close. So I'm looking at it carefully. What did we just do? It was April, all the way up to April. So now we have a position. See what that changed? Now we have a position on the 1450s. We sold them for $1.45, and they popped to $1.50. I think I asked. So we sold them for $1.50, and now I really want to buy these for $2.50. I do have an offer in. Here, see this 1250 call? And if I say view orders. Okay, so I filled the 10 short. Here I've offered 245. If I change that now and I replace this order at 250, maybe I have a better chance of filling it. What's the bid and ask here? 250, 265. No, I'm not going to fill it because it's going up too fast. All right, but meanwhile, realistically, I should, so I'm going to replace that order. And a good thing about Thinkorswim, too, you don't pay for canceling an order and changing it, which is very important. But now let's take a look at the active trader screen, see what's going on here. So oil popped. I just upped my bid to 250. And if I fill it, I'll have my $1 spread, right? Because I sold these calls into the pop. I got a pop and it filled. Now, as this pop fades out, I'm going to hopefully fill my calls that are a lower price that I'm asking for that I'm offering 250, and then I'll have my $1 spread. The same spread that I couldn't fill before, I'm now going to be able to fill. And oh, and by the way, well, I'll show you when it's finished. But the other contract is still sitting there because at no time did the spread order fill. But doing it this way, by breaking it up into legs, I'm going to show you, I'm going to fill both parts of the spread. Meanwhile, look at the Dow. The Dow went the other way on me. Yikes, $500. Probably because the oil popped and all the energy stocks went up with it. Did anyone say anything on oil? Did something happen? Look at the news. Oil traders, 430. Got the API report later. Don't know what's causing the pop, so we'll find out. I'm still comfortable shorting the Dow, though, just because I see it as a losing position. 62. Now, I have 4 at 62, and here at 88. That's 16 points up, right? So what's that going to do to my 4 positions? It's going to raise my, oh, that's not bad. It's going to raise the price of my 4 by 4 cents each. So I'll end up at 66. So I do want to sell one, if I can, at 88. I missed my opportunity, though. I think it's going back down. But see, that's all I did. I put in an offer, and if I since I only had 4, if I sell another one 16 points higher, then it's going to bring the average of those 4 up by 1/4 of 16, which is 4 points, and it'll raise my average price to 174.66. That's called scaling in. Then I would raise my exit price. I would start to look to exit at about that price breaking even. So, again, you got to pay attention. You can't do like flip from thing to thing when you're doing futures trading because you'll never keep track. But that was the gist of it. Ooh, look how messy that's getting. All right, back to there. Let's see if anybody's asking any questions. At what point Treasury is interesting? I don't find Treasuries very interesting, frankly. We like to short TLT when it hasn't been too high in a while. Like over 130, we like to short it. That's been pretty consistently a good idea. It didn't work out here, but it was great here. And it actually did work here eventually, but this was painful in the beginning of the year. We did it over here. But at 130 is a line that we think is unsustainable. That's when 30-year notes go down to 2%. 2% is just, it doesn't keep up with inflation. It's a completely unrealistic number. As much as the Fed pretends there's no inflation, it's not going to happen. And of course, the Fed's going to raise rates, so that's going to make it ridiculous too. But for now, a drop in the market is still going to send people panicking at Treasuries, and Treasuries, if they spike higher, I'm going to be very, very interested in shorting that spot. Um, Musk says it was a new piece, the 60 Minutes. It wasn't a repeat of the one that they had. So what are they saying? Anything exciting? I did not watch it. I was told it was the same piece. Okay, just making sure I asked everybody's questions. It was in the glue and way higher than allowed. I refuse to buy BP gas. What about Dow Chemical Trade seems cheap? I don't really understand why interest rates go up, people buy Treasuries. Why if interest rates go up, people buy Treasuries? No, people panic in the Treasuries. People go to look. If you sell your stock, you got cash, right? You're a rich guy. You're a billionaire. You sell your stock, you now have cash. What are you going to do with $100 million? Okay, the FDIC only insures $250,000 per account. Okay, you can go to brokers and they'll give you like $5 million. If you go to broker accounts, they'll insure $5 million, but they pay no interest. So really, they're charging you 2%, right? Because if inflation is if you can get 2% in the Treasury bond, but if you put your money in a brokerage account, they'll give you $1 million and maybe half a point interest or 1% interest. Let's say you're still losing 1%, right? Just because they're going to guarantee it, you still have to trust the broker. People who trusted Bear Stearns got screwed. So you say, okay, what's the safest thing to do with my $100 million? Well, it's going to be buying Treasuries. They're going to pay you back. They might devalue the dollar and pay you back, but they'll pay you back. And really, the answer, if you have $100 million, nothing because the Treasuries are going to lose value over time too as interest rates go up. So there's really nowhere to put money. But right now, short-term, people put money into Treasuries just because there's nowhere better to go. You don't want to put it into a house. That's a real iffy market still. You can't put it into gold. That's an iffy market. You can't put it into oil or commodities. All iffy markets. The only non-iffy market is the stock market. That goes up every day. And when it doesn't go up, somebody saves it. That's the only non-iffy market. But when the stock market lets you down, boom, right back to Treasuries. That's the way it goes. There are still a lot of old people who think in terms of stocks, Treasuries, cash. Those are the three things that they have. And when they move their balance between those. And look, there's plenty of multi-billion-dollar funds that do the same thing. So Treasuries are always going to be in the mix. And frankly, I mean, look, once this nonsense with the Fed is over, they should probably start going back to some kind of normal thing. It should be a relationship between stocks and Treasuries where if there's not this constant printing of money, then there should be a balance. When stocks are down, Treasuries go down. You know, the interest offered by Treasuries goes down. When stocks go up, the Treasuries offer more interest to attract money to the Treasuries. That's how it's supposed to work. That's supply and demand. There's different demands for a static supply of money. We don't have a static supply of money. It screws everything up. Great. All right, almost done. So lumber liquidators, don't panic, be a value investor, and then we can eventually sell dividends against these stocks. I'm going to do that in a 5% portfolio. I'm going to initiate a couple of these butterfly kind of trades. At first, I was thinking it might be too complicated, but then I realized, like, look, you have to do bulk call spreads and stuff anyway. It's like you can't just, you can't make money in options and not do spreads and sell some calls and so on and so forth. So the butterfly portfolio, God bless it, is not counting the short-term portfolio, which has some very lucky moves in it that did well. The butterfly portfolio, first of all, uses almost no margin, 26,000 in margin. It started with 100,000. It's up 54%. There's your 5% per month. This thing pretty much makes a little bit less. And I mean, God bless it. It is so steady and stable. Walmart just took a hit today. We thought it was going to make 72.50, but unfortunately it just fell right ahead of our August expiration. But it's such a simple, and I'm going to write an article about it. It's such a simple, basic way to go. And this is kind of about that. John. It was John. And these are kind of like volatility skews that John was asking about. Because what are we doing? We're taking a long position, like on Disney. We buy the $100 calls. Well, what do we do? We sold. Why does Disney have to be a bad example? Okay, OIH. There you go. We bought the $40 calls. We sold the $35 puts. Okay, that means that if we sell a call, and we sold the August 33s here, if we sell a call, we're protected against it going higher on us because we already have long calls. If we sell a put, we're protected against it going too low because we already have a long put. So we are playing the volatility. In other words, our long positions are backstopping the short positions that we sell to make money because the volatility, the volatility of the short-term positions is such that the premiums expire much faster than our long-term premiums will. And because of that, we end up making a constant, we make a very, very steady income just selling against the longer positions. We're not owning the stock. We don't need to. We're just owning long-term positions at what we consider reasonable ranges. We pick a reasonable range that we don't go too far above or too far below. We cover ourselves, and then we make all the money just selling puts and calls in between for 2 years. Usually the 2-year time frame. So when the 2018s come out, I'm going to start initiating some of these for the 5% portfolio because it's a fantastic way. Then we're going to have 2.5 years almost to make money selling these things. And you make really, really good, steady money. Every single month, money pours into your portfolio. And like I said, we have $130,000 cash. We have more cash than not more cash than profit. We have almost as much cash as we have profits. So we have a 54% profit. That would be $154,000. $30,000 of it is in cash. We're only using $26,000 in ordinary, not even ordinary margin. This is a full margin. This is an IRA type margin. In this particular, in power options, which is what I use to track the portfolios, they treat it like it's an IRA. Like they charge you 100% margin on things. We're only using 26% margin. If you were in a portfolio margin account, you'd be using nothing, $13,000, $10,000 of margin on these positions. And they are just little money machines. Sometimes you lose. Look, here's one. We lost $10,000 on this OIH. We lost $9,000 on this. Sometimes you win, sometimes you lose. But on the whole, the math of it is very, very much in your favor. And month after month after month, you can grind money into these portfolios with very safe, very stable positions. All right, it's one of my favorite portfolios. We never talk about it, butterfly portfolio. We don't talk about it because it's so boring. Nothing happens. Tomorrow, I'm going to have to do a write-up on this portfolio to do all these rolls. But that's what we do. Once a month, we roll our positions, and that's it. And that's how we make our money. Simplest thing in the world. Fantastic portfolio. Okay. Got to get going. So anybody have questions before we quit? Oh, CK said Dow Chemical seems cheap. It probably is. I'm look at it closer than just to make a glib sort of thing about it. Dow. Nope. Dow. D-O-W. It depends why they're selling off and what happened to them. I don't know exactly. I don't follow them. That's an ugly chart, though. I don't know what's going on, but it's a very ugly chart. If I forget to follow up in chat, you can remind me next week, and I'll take a look. Where are we? Meeting burner. But remind me early. Do it early in the thing, not late. What else? Okay. And okay, yeah, John. Example, yeah, we'll do that too. We'll start talking about the butterfly positions. That's a good way to play that, actually. Almost any kind of market you can play those sort of things. All right. So meanwhile, my Dow things did not fill on either side now. Oh wait, did I fill one? Oh wait. Maybe I filled too soon. Yes, I did. So now I have 5, and you see it's up to 146,720. So it did take that position that I did the extra sale on. So now I have 5 of these guys. Oh wow, look at that. I can get rid of that guy. He's not important anymore. There. Even has moved up to 174.67. Now I'm probably not going to add to that. I thought Shad 17,550. I would double down again on the bet that holds, but I don't even think they're going to get over 17.5. So I'm content to ride this thing out and see what happens to it. Wow, look at we shorted these guys in the morning. They're down at 12.20. They're down at 12.13. That's a nice ride for people who got that one. Oil, meanwhile, did we fill that? USO, no. Wait. Yes, no. No, we don't have the buy position. See if we fill that buy. All right, but we talked about a lot of stuff today, so I hope some of it sunk in. You know, we talked about filling positions by taking legs. Talked about scaling in and out of options. The same thing, scaling in and out of futures positions. The same thing goes to scaling in and out of those legs. You don't have to sell all the positions at once. You can sell a couple on each side, get those filled, then sell the next couple, then sell the next couple. You know, especially when you've got these 6-month, 8-month, 10-month positions. There's no rush. You don't need to be in a hurry. You'll get it eventually. All right? And if you don't get it, then you don't get it. Don't chase. The worst thing you can do is overpay. It's just never worth it. It really isn't. All right? And we talked about the value investing. If something's cheap, you have to decide you really want it. If you don't really want it, you know what? Before you buy something, okay, when you're buying something that went from, like lumber liquidators, when you're buying something that went from 50 to 25, and it all ties back to the same thing, though, the scaling in and all that, it's on a longer time frame. We didn't take a huge position in lumber liquidators. We took a position. We like where it's looking right now, and we're willing to put more money into this position. But that's scaling in, okay? We didn't jump all in at once and then cross our fingers. Because every step of the way, even now, though, even if I say, okay, and that's why we haven't pulled the trigger yet. We're waiting for the 2018 calls to come out. But when I look at that lumber liquidators position, and we'll do portfolio reviews this week. When I look at this lumber liquidators position, and I say, hey, I got these $15 calls. I got 20 of them. It's $18,000. That's not a lot. It's a $750,000 portfolio. I got $18,000 at play here. You know, and by the way, less the short calls that we sold for $6,000, so it's really $12,000. I'm sorry, not the puts. Less these guys. So it's 13. Let's say it's $13,000. So I have $13,000 tied up in the long side. I'm going to have the stock put to me at 25 unless a miracle occurs. But my net isn't 25 because it's 25 minus 670. So my net's around 18. Remember what I said? $18. So at $18, let's look at that logically. Let's say I do get assigned lumber liquidators and I end up owning it for $18. I can sell the 2017 $18 calls for $4. Right here. I can sell those guys for $4. Okay? And how much is 4 into 18? 4 divided by 18, 22%. I don't mind making 22% over 18 months on a stock. I don't consider that a bad thing. I like to do better, but as a fallback position after a disaster, if the thing is put to me when it was at 25 and I sold the things and now it's at 15, and all that's really going to happen to me is I'm going to drop my basis, because the second I get $4 for these 18s, I drop my basis from 18 to 14. So now I own lumber liquidators at 14. And if I get called away at 18, I get a $4 profit, not off the 18, off the 14. All right, so how much is that really? That's a little more. That's actually more than what we're saying, because we divided by 18. So if I take 4 profit divided by 14, that's 28% in 18 months. That's right where we want. 1% a month or more than 1% a month, you're in good shape. That's a good position. And that's our fallback position from a disaster. And it doesn't stop there, because we're going to sell 2017 and 2019, 2021, and 2023. We'll do this every year, and we'll knock $1 off and $2 off and $3 off. But it's all because I got lumber liquidators cheap. I got my 20-year position cheap, because I saw the value of it when it was cheap, because I didn't think in terms of, oh my God, I lost $10 this year. I think of it as saying, oh my God, I'm going to get this stock for $15 a share on the average, and for the next 20, even if I sell $1, even if I only sell $2 a year, the value off of this stock, it's the same value I get from when I buy an apartment for the long term and I'm going to rent it out. I have a stock, I'm going to be able to turn into a money maker down the road, and I have a long-term plan for it. So you try to buy companies that are cheap, that aren't going to go bankrupt on you. That's also key to this whole thing. We really want to find a stock that's not going to go bankrupt. Hopefully lumber liquidators won't. Sometimes we're wrong. We still have GTAT from last year to show it. Is that even a thing? EQ now, right? There you go. Look at that. Holding on to 7 and 8 cents. That's a stock. We lost our asses on that one because we didn't think it was going to go bust. So sometimes you're going to have losers, but if you have a portfolio, and if you have a portfolio of 20 stocks that are making 10, 15%, and one stock goes bust on you, it doesn't wipe you out. It's 1/20th of your portfolio went to zero. So let's say it's a $100,000 portfolio. You lose $5,000 and went to zero. But if the other $100,000, the other $90,000, $95,000 gains 20%, you're going to be ahead of the game, even though it was a bad loss. So sometimes we do have a bad loss. That happens. Part of the thing of being a value investor. It's like sometimes when you buy cheap jeans, you find out they were knockoffs and their stitches ripped or something like that. It's a factory reject. Sometimes things seem cheap and they're not. But that's, again, the point is you diversify your portfolio. You don't put all your risk in one place. You scale into positions. You don't take over big risk when you start off. Try to gather more information as it goes along. And if you do and you build yourself up a portfolio of good, cheap companies over time, it becomes a wonderful, steady way to make money. It's like that goes back to that video I always make people watch, The Man Who Planted Trees. You just keep finding yourself those good, steady stocks that are going to grow and grow over time. How to make money off. And that's what we're trying to do here. Okay, well, that's a good place to wrap it up. We'll get back to chat and catch up on things, and I'll see you guys back inside, okay? Thank you, everybody, for coming. Please don't mention ECAT. Sorry, John. I know it's like a trauma thing for some of us. All right, comments on Cliff. I feel the same way about Cliff. I think they're going to survive, and I think they're worth accumulating down here, although very painful. And one of them's going to, something's going to go bust. Okay, we want to hold on to Cliff. We want to hold on to Transocean Rig. We want to hold on. Some of these guys is going to go bust on us. So hopefully the other guys will make up for it. But it's hard to imagine that we escape that well on everybody. I haven't heard anything to change my mind yet, but that iron ore and cliff is the most dangerous because the iron ore prices are just relentlessly low. It's really horrifying how low that thing is right now, and it's not coming back. Rig's not coming back either. Rig's having huge problems. So they've all got problems. You never know when a bank's going to go crazy. When a lender is going to go nuts and start calling in contracts and calling saying you're in violation or something like that on the loan agreement. Once that happens, things can spin out of control pretty quickly. So you just have to keep your ears open. If you have stocks like that, you do. Financial problems might be. Business problem-wise, Cliff isn't losing money fast enough to really go bankrupt. Clash buying anymore. So, all right. Thanks a lot, guys. Been great talking to you, and we'll do it again next week. All right. Take care.